it puts you in a really good spot. You have a position of power. You can leverage things. You have more influence in your community. You name it. There's more influence in the hands of bankers than almost anybody else. So that's one of the reasons why people go through the grueling process of saving in order to get enough capital to create a bank.
Just had a question that I thought would be kind of a good way to kick it off. And that is, how important is it to have the habit of saving?
Oh, man. Is that not like the most important foundational element?
Yes. Quite simply, yes. Without it, really, you're handcuffed otherwise. So that was a question I thought would be a good way. How important is it? Yeah.
I think that oftentimes in our culture, we take our saving and rather than saving, we either, a lot of us tend to spend it on consumeristic stuff. But for the people who are willing to wait to get those pleasures of consumerism, rather than saving their money, they're going to go invest it. And they remove it from their control. They put it into someone else's control. And so they're never really operating from a position of power because they don't have the capital to be able to choose what to do. They're subject to the current market conditions or, a various other host of things.
Right. Yeah. They're under the control of the need for capital, if you will. So they have to have a job all the time.
I just had a client of mine, Ray, reach out to me, I don't know, 2-3 weeks ago. And he said, hey, I was just listening to something you were talking about. And you had mentioned that there was maybe 5, most Americans save between 4 and 6% of their savings. Of their income. And he said that through practicing infinite banking over the last 3 to 4 years, he has put himself into a spot where he is actually saving 26% of his income.
Wow, that is awesome. That's awesome. So that's after tax dollars. He's saving 26% of what comes to him.
Yeah. Awesome. Imagine where that puts you in the position of power as far as making decisions.
Yep. Right. In a very short period of time. Within, like you said, what did you say? He's been doing it about 4 years?
Yeah. 3 years. Yeah.
Yeah. So just even think about another 3 years where he'll be with this savings mechanism.
Yeah. It's exciting. Savings is huge.
Yeah. Yeah. And we mentioned just before we turned on the cameras that, the Boeing 747 gets more efficient the further it flies. And it's the same with the policy. It gets more and more efficient and just takes off as time goes by.
Yep. Yeah, it's crazy. One of the cool things about savings is if you're doing it correctly, you're building capital. And from the position of capital, you have the ability to go do something else. Now, if you want to invest in real estate, you want to invest in stocks, you want to invest in your own company, yourself, life insurance, whatever, you could do whatever you want with it. Some people, they elect to go create a brick and mortar bank. You know how much they have to have in savings in order to do that? According to Nelson, 24 years ago, the number was $20 million.
Right.
They have to have it in savings. You think that they just came up with that without savings?
No, other than maybe having rich friends.
Well, the rich friends didn't get it by spending it either, right? Yeah, someone had to save.
Yeah, somebody had to save.
Yep. From that position of saving, they're able to actually have enough capital to then create a bank. So one of the things that I think is a good question to ask or a good thing to think about is why create a bank? Like a brick and mortar normal bank, why would you, Ray, if you had the capital, why would you go out and create a bank like the ones we already know about?
Well, yeah, if you're asking about the ones, the brick and mortar down the street, well, because they not only do they get deposits coming in to the bank and begin to grow so that they can, the deposits come in so that they're allowed to make loans, and they don't have to just make loans based on the number, just say $1,000 came into the bank. They don't have to limit themselves to just loaning out that $1,000 because of the fractional reserve system. They can loan out, way more. So they create money out of thin air. I was just talking to a client yesterday, and he said that it just came to light for him that that's what they were doing. He said he never knew that. And I said, yeah, it's called the fractional reserve system. And now apparently they don't need to have any reserve.
Yeah, unfortunate.
So, yeah, it's very unfortunate, because that also adds to inflationary pressures as well, because you're putting more dollars out into the economy that nobody brought any value for those. They just create them out of nothing, out of thin air.
Yeah. So one reason why someone would want to get into banking is so that they can create money out of thin air. If that's why, they might want to do that. I think the bigger drive for people over the test of time, even before fractional reserve was a thing, people want power, and they want the ability to choose, and you get that by having control. And when you control cash flow, it puts you in a really good spot. You have a position of power. You can leverage things. You have more influence in your community. You name it. There's more influence in the hands of bankers than almost anybody else. So that's one of the reasons why people go through the grueling process of saving in order to get enough capital to create a bank. They know it's going to take quite a bit of time for them to become profitable. They know it requires a ton of capital, and they know the industry is heavily scrutinized. They know the IRS is watching every step all the time. They know they need permission for everything, but they still go through all those hoops because they also know that being a banker gives you that position of power and influence. And with that, you can create the world that you want to live in.
Yeah, the other thing about that is when you create that kind of power, people that need capital come to you.
Mm-hmm.
So just as for instance, JP Morgan and Tesla, not Elon Musk Tesla, Tesla, the inventor, went to JP Morgan to help him build this wireless radio thing. And Morgan helped him for a bit. He told him how much he thought it was going to cost, and it went over. And Morgan said, "You're all done. I'm not giving you any more money." But those kinds of things come to you as opportunities to invest at cutting edge stuff. And so in his day, that's what he was doing. But yeah, you're right. The power of it all.
Yeah, it's huge. One of the things that you can't forget, no matter what, if you get yourself into that position of power, you have to be willing to deal with the skeletons in the closet. And those skeletons would be your own human nature. And that's where Nelson was talking about the God-made laws, not man-made laws. Like, you're going to make loans as a banker, and you're going to require those loans be paid back to you. Well, if you make loans to yourself, you better be requiring yourself to pay those loans back to you. There is no free lunches, right? You need to be an honest banker. As soon as you start being dishonest, that's when you run into the problem, like the Bank of Midland, Texas, that Nelson mentions, failed because 26% of its loan portfolio was out to the board of directors, and they weren't paying back their loans because they didn't require themselves to. And the areas that they invested in weren't great investments. They were a little bit more speculative. So they
Mm.
didn't end up making money. When everybody found out about it, that's when they found out that 26% of the loans were not performing. A lot of people withdrew their money, and the bank ended up crashing. It was pretty bad, and it was all because the bankers, the people that went through this entire process to create this
Right.
entity of power and influence, they weren't willing to follow their own rules that they set for other people. They weren't willing to follow the rule that the God made rules. It's crazy.
Yeah, yeah, and there were other banks across the state of Texas that did the same thing. They were all trying to cash in on the oil boom, and so I think they thought it was just going to go on forever. And they were going to be able to just take loans and not have to pay it back. But yeah, even, it doesn't matter. You can't not pay it back and leave yourself susceptible to a downturn, and then people get, as you said, yeah. So
Yeah. And it's funny how much speculation banks do, um, because money is relatively easy for them to come by. People want to deposit their money in banks because they feel like it's safe. Banks are supposed to be trusted, especially when they're FDIC. Well, if money's easy to get, it's also easy to lose. And when you look at the history of banks just in the last 20 something years, in the year 2000 there was 8,300 banks that were FDIC. And then
mm,
if you look at the 2023 numbers, there's only 4,000 banks. So we've lost 50% of the banks, and a lot of those were mergers and takeovers by other more profitable, bigger banks. But 567 of those banks were actual failures, which is like 6-7% of all the banks since 2000 have failed because it's they're either investing in speculative things, or they're not um, they're not being studious enough to make sure that they're going to, whether they're not being honest bankers or they're investing in really speculative things. It could be a whole myriad of different things, but ultimately I would say that it just because you're a bank doesn't mean you're safe.
right, yeah, no, it really comes down to the leadership inside of a policy. If we're going to compare it to a bank, like we already know about with the policy, we are that banker and we need to take care of it, like a fine piece of furniture or a fine car or whatever. You really want to take care of it because it will take care of you.
Hmm.
And the opposite is also true. If you don't, it won't. It's just, yeah. So, yeah, I think that probably what happens is, this isn't everyone, but there's this, without making it sound bad, it's greed. Greed can take over. And yeah, that's something that we all are aware of that goes on. So anyway, go ahead. What else we got?
I want to
So
just
go
uh,
ahead.
I want to put it in maybe today's pictures. Just ask a question really quick. So maybe you as our listener are listening to this and you're in that position of being a banker and you know what it means to be an honest banker. I just want to step back and look at business as a whole, because or just maybe a small business. A lot of us can relate with small businesses, and um, so if you have a plumbing business that has 100 employees in it, and 25 of your employees were not doing what they said they were going to do, they're not doing their work, all they're doing is showing up and collecting their hourly wages, what would you do?
Yeah, well, you'd let them go.
Right.
Now, if you were of the sort, you may give them a warning, but they probably wouldn't change their ways. You'd let them go.
Yeah, you'd cut them loose.
Yeah.
That is the role of the business owner. You have to recognize where you're losing. Now, to relate it a little bit more with that Bank of Midland, Texas, let's say that those 25 employees that aren't doing anything are your friends and family.
Mm. Yeah. You still got to let them go.
Still got to let them go.
Yeah.
That's hard, though.
Yeah. Yes. Yes. It's really like like when you get on a plane to travel somewhere, they go through all the safety things, and they say put the mask on yourself before you put it on your child or the person sitting next to you. And it's really, if you aren't okay, none of it's okay.
Mm-hmm.
Meaning that if you don't let those 25 go, there's chance that there is a chance that you could lose the whole thing, and the other 75 would go too, and it wouldn't have been it wouldn't have been anything that they had done wrong.
Yeah, there's a huge chance of that, right?
Yes.
If you're operating at a 10%, 20%, let's just say, a lot of people are very happy if they're operating at a 10% profit margin. A lot of business owners that I know, 10% is a good profit margin for them. If 25% of your workforce is not performing, you're at a pretty big deficit right there. So it's not going to take you very long before you're completely out of business.
Yeah, you're at risk.
Yeah, huge.
Yeah. Yep.
Yeah, and so it's important to understand banking is a business. When you go down this path of becoming your own banker, you're becoming your own business owner. You're becoming your own banking business owner. And you have to treat it like that. If you mistreat the laws that God set up at the beginning, these laws of integrity and just being an honest business person, if you disobey those, you're going to do that at your own peril. I mean, that's exactly what Nelson says. Disobey his laws at your own peril.
Yeah. And just like the First National Bank, if you think you can outsmart the God-given laws, you have to think again. It's going to happen.
And if you can't do it, just don't go into the banking business. That's all. It's not bad. You just have to know yourself. That's a lot better than getting into the banking business and finding out you don't have the integrity or the character to handle it. Yeah, I would definitely steer you more that direction than say get into the business to find out what you're made of. No, you should know what you're made of, and you should be willing to do the hard work before you get into the business.
Right. Yeah. That's when I talk to people, and before we start down this road by starting a policy and getting it going and all that, is I want to make sure that they fully understand what they're getting into, because it is a very unique situation, lifelong, and I want them to stick with it. And if they don't think that they quite understand it, because I think really when people really understand what we're talking about here, starting your own bank, if they really understand it, they'll get really excited about it.
Mm-hmm.
And those are the people that will stick with it because they really have caught it, as Nelson would say. So, yeah, you've got to have the integrity and the stick-to-itness and all of that. And I have to say that it's actually helped me grow in that way since we started. I would save money and then spend it, for something, whatever. And there was no timetable to replenish that. necessarily. But now in this case, I feel incentivized to put the money back into the policy after I've taken a loan, to have a consistent plan, replenish that capital, so that it can be used again.
Yep. And that's all bankers do. Even your brick and mortar bank, that is their business. They loan money out to people, require those loans to come back. They've generated cash flow, and when there's enough capital back in the bank, they're going to go loan it out again, and loan it out again, and loan it out again, and they
Right.
create massive amounts of cash flow. It's impressive. I mean, there's a reason why banks are the nicest buildings in town.
Yeah, those and insurance company buildings.
There you go. Because insurance
When,
companies do the same thing. They just loan money out at interest. They're
yeah.
just a different. It's just a different niche. They are in the business of insuring lives, whereas banks are just in the business of making money. They have a much smaller vision of the future than the life insurance companies, which again speaks to why life insurance companies tend to stick around a lot longer than banks,
Mm.
because they're always looking out 20, 40, 50, 70, 100 years.
Yeah. They're here for the long haul.
Yep.
So,
Well, cool. Any other questions there?
so here's one. Tell me what you think of this. So paying back, I'm thinking in terms of a policy, paying back a loan. Instead of thinking of it as a loan, although it is, but the whole idea around incentivized savings, incentivized meaning when you're refilling, think of the loan as, could you be thinking the loan as just putting money back into a savings account?
You could, but how do bankers think about loans?
Well, go ahead. You tell me.
When you deposit money at a bank, is that a asset or a liability for the bank?
That's a liability because they actually, if you come looking for it, they're going to have to come up with it. So
Right.
yeah, liability
So if a deposit is a liability, then a loan out to somebody else is an asset.
is an asset. Yeah.
That's how bankers think. If you want to become a banker, think like that. Make a loan to yourself and treat it like an asset. That asset's supposed to cash flow back to you as the banker.
Yeah, that's a. I like that better than what I was saying. About the savings account. Yeah, think of it as a savings account. Actually, think of it as an asset. That's great, Kyle. That's
Yeah,
great. Yeah,
it's all in how we think.
yeah,
Call it what you want, but if you're treating loans as assets and you're being honest and you're paying them back and you're loaning to things that are going to generate more cash flow towards you, all that other kind of stuff, you have an abundant mindset, and there is no end to that. It's
no end.
bountiful. And then all of a sudden we're really getting into the infinite banking concept.
Mm.
Not the finite, oh, okay, cool. Well, we have $100,000 of loans outstanding. There's a finite amount of money that can go back into this. All that is just scarcity. You're just wanting to pay those loans back so that you're being honest. No, if you're treating this as a cash flow asset and thinking, what else can I do? How else can I go serve people? All of a sudden, those loan repayments, they're just helping you further your own mission. It's not savings. It's not incentivized savings. It's helping you further that mission that you've been placed here on earth to do. I don't see anything wrong with that.
No, there's everything right with it. Well, that's all I have, Kyle. You want to say any final thoughts on this?
No, I don't. It's real straightforward.
Yeah.
Bankers make a lot of money and they hold a lot of power. if you want that, you can get it. It's easy.
Yep.
Just don't do it the traditional way because it doesn't work. It's expensive. It does work. It's just very expensive.
Yes, right on.
Thank you for joining us on the Sound Banking Podcast. If you're listening on YouTube, make sure to like and subscribe and click on the notification bell. Otherwise, join us on Apple Podcasts and Spotify for more content.